welcome back. Shush. I'm very pleased to be welcoming you back into the second session of the day, where we're going to have a roundtable discussion on FinTech, Big Tech, and competition in financial services. Je voudrais dire à ceux qui souhaitent.
I would like to make it clear to anyone who needs it that we have headphones in the little pockets of each seat, which enable you to access interpretation in English or in French, or perhaps to hear better. If you need to, you can also tune in for that reason.
I will start by setting the scene for today's discussion, and we will also be asking you a question. So if we could have the QR code displayed. As a background, it would be interesting to know whether or not you are as yet banking on your mobile phone. So you have 4 questions. So the question is, are you banking on your mobile phone? No, never. 2, I use the apps provided by my traditional bank, but I don't have other bank accounts with mobile banks. 3, I multi-home between a traditional bank and one or several mobile banks or fintechs. Or finally, I bank exclusively on my smartphone. So it'd be interesting to see what people are actually doing. Interesting. All right, so the arrival of fintechs is profoundly changing the banking sector and the way that we bank. The rise of fintechs and TechFin has further sharpened competition in the market for financial services, leading to a significant lowering of transaction costs and switching costs for users. This in turn has enabled previously under or non-banked population segments to have access to finance and financial services. In addition, the so-called big techs, for instance, Google, Amazon, Facebook, or Apple, to name just a few, are developing sophisticated analysis of big data, including of consumer data, such as shopping habits, frequent search terms, and other details such as consumers' engagements on social media. Leveraging this and exploiting consumer brand loyalty, these big techs are starting now to enter into various forms of financial services. This has already happened in Asian markets, where big techs already successfully have entered financial payment services, peer-to-peer lending, and investment services such as money market funds. In this manner, they are providing convenience, improved product choice, and efficiency gains, for instance, lower costs and faster deliveries of services benefiting consumers. This also gives them a competitive edge over banks and other traditional financial services providers in the Asian markets. However, increasing big tech dominance across different services and different markets may also lead to market concentration and perhaps new forms of systemic risk. So today we will be discussing with the panelists how the landscape of financial services has changed in the past 10 years, the ways in which fintechs and big techs are competing with traditional banks, and we will outline some possible regulatory approaches. Regulators in particular are faced with a tension between encouraging competition, which, as we have seen, has helped extend access to financial services to previously underbanked communities, but also to ensure prudential regulation which aims at preventing new systemic risks and a new financial crisis from appearing. So with me today to discuss these issues, I'm very pleased to be introducing, on my left, Sarah Court, who's the Commissioner of the Australian Competition and Consumer Commission and also Associate Commissioner of the New Zealand Commerce Commission. And I have Joel Rosenbaum, who's Head of Strategy and Corporate Development in the Global Digital Division of Banco Santander. And then on my right, I have Janos Barberis, Head of Entrepreneurship and member of the advisory academic board in the Center for Finance, Technology and Entrepreneurship. He's also the founder and the CEO of Supercharger. And finally, but not least, I have with me Jason Maude, who's the Chief Technology Advocate for Starling Bank of the UK. So starting by looking at how competition is changing in banking services, I'd like to ask Jason from Starling Bank, how is the landscape for banking services changing now? How do you see the emergence of Fintechs in the UK, of course, but also across the globe? And how do you assess the level of competition in the sector?
Good afternoon, everybody. So I'll start with the last question. How do I see the competition in the financial sector? So I see competition as currently opening up, growing in size. There was a big understanding in the UK and in other areas after the financial crisis about 10 years ago now, that the financial sector needed to open up, needed to get more and more competition. The UK government and regulators are particularly concerned about banks that are too big to fail, banks that essentially have an implicit guarantee from the government that they will be bailed out, because if they collapse, then they take the economy down with them. That is incredibly dangerous, as it introduces a large moral hazard into the equation, where the banks can essentially choose to behave how they like, because if they profit, then they keep the profit, and if they lose, then the government bails them out. So competition needed to be increased, and it is increasing. And it is not only increasing in the sense of there are more players in the market, it is also increasing in the sense of what those players are competing on, how they are trying to attract more consumers to open up bank accounts and the like with them. Prior to the arrival of Starling and other similar fintechs in the UK, banks would really compete only on two axes. There was how much you got charged for your financial services, so the interest you paid on your loans or your overdraft and the interest you got on deposits, and then the customer service when something went wrong. And by and large, unless one bank was offering a dramatically better rate, or there was, you had a particularly bad customer service experience, you wouldn't switch banks, which led to the old adage that you were more likely to get divorced than you were to change banks. So what happened is that people in the UK came along to their bank account. They were 18, they were going to university or starting their first job. They needed a bank account. They would look at whether the banks were offering them a free toaster or a young person's rail card or similar. They would decide which bank to go with on the basis of that, and then they would stick with that bank forever. And that is how competition went in the banking sector. Now, however, fintechs come along and they start saying, what we're going to do is we're not only going to, try and compete on these traditional axes, we're going to open up new axes. So we are going to compete on what you can do with your bank account, the features that you have. So Starling came along and introduced card freezing. This is the concept of if you lose your bank card or you think you've lost your bank card, you can go into the app and you can turn it off temporarily. And then if you find it again, you can turn it back on again. Now, this contrasted with what previously happened, where you think you've lost your bank card, you had to ring up the bank and cancel your bank card, and then you would find it down the back of the sofa and be told, well, it's too late, you've cancelled it now, it's gone. Now you have to wait for another, 5 or 6 weeks or however long to get the physical card, the new physical card, during which time you are cut off from financial services. With Starling, if you think you lose your bank card, you can turn it off, find it again, you can turn it back on, and if you really have lost your card, you can cancel it, and although the physical card will take time to get to you, you can get a new virtual card and provision it into your Apple Wallet or your Google Wallet immediately and start spending again. So you are not cut off from financial services in the same way. So competition is really increasing, not only in terms of the number of players, but also in terms of that new axis. And another new axis which is opening up is in data interconnectivity and the ability of customers to transfer their data from one financial player to another. So there really are the competition is expanding in multiple different ways. And I think this is a very good thing and offers a lot of benefits to the consumer. And I hope we will explore that more as the panel goes on.
Certainly. I have to say that the idea of freezing your bank card speaks to me. I have a French bank, I won't name it. But indeed, if you think you've lost your card and by mistake you tell the bank that this is the case, then your bank is your card is immediately taken out of circulation. And if you have online payments, you have to go to every single provider and re-enter the new card number once you get it some 10 days later. So that sounds very good. I wanted to give you some figures about the rise of fintechs. So these are recent data compiled by E&Y. And so the number of fintech startups in Americas in 2019 was 5,779. In Europe, the Middle East, and Africa, there were 3,583 fintech startups. And in Asia Pacific, there were 2,849. So these are the most recent numbers. So Joel, if I turn to you, as a traditional bank, how does Santander see this rising challenge from the fintechs? We know we've had several roundtables at the OECD about competition in financial services, and there seems to be different models of competition from traditional banks. Some embrace it and they try to enter into partnerships with fintechs, but some also have a more aggressive buying up the competition or these sorts of things. So how does a traditional bank survive the pressure from the fintechs?
From our end at Santander, I think I certainly would speak for us more so than I would for other banks, because I think in the sector there are a variety of views. I mean, for one thing, to point to the level of change and the stats you just cited, the number of fintechs in the US in 2019 is almost as high as the number of total banks in the US. So there's been a sea change in how the sector is evolving. From a banking end, I mean, we sort of see technology and banking going together. Santander is committed to building the world's best open financial services platform. And in building a platform business, we see fintechs as our clients and partners in certain areas. We also see large technology companies involved in this. We don't exactly see a zero-sum game between the parties. And in many cases, we certainly invest in fintech companies. We have, in fact, a Santander fund that does minority stakes. It's not just simply buying out fintechs, but we see lots of opportunities. For our view of the landscape, I think some of the pain points that we feel is where sort of sector-specific regulation has had maybe unintended consequences on competition as the technological landscape has changed. And with technological barriers going away, also geographic barriers have changed as well. For instance, for us, new product launching on products that do not touch deposits or even credit risk issues can take 3 times as long at least, because it goes through the same regulatory process as a consumer deposit account major change or something. So we have those sorts of issues. I think with data is another example, and I think for us, for instance, PSD2 in the European Union, we're not opposed to the sharing of information with consumer consent, and we think that it's a good thing. But in many cases, the bank is passing on data to a partner, and that has its own partners that pass it on back to a technological company. And that technology company may have different uses and ways to elaborate and enhance the data. And the non-financial piece of that data that the European financial institution would like to use to enhance its own products, it doesn't have access to that. So there are some areas where we'd like to see more balance on the seesaw. But overall, I think we welcome the opportunity to integrate and work with fintechs. We have our own initiatives. We would just like to see, in some ways, more proportional regulation and approaches to services where you're not hitting at systemic economic risk. You're not hitting at deposits and other things. And we also see differences among geographies. For instance, how the United States treats the organization of its banks and holding companies versus how European ones do with consolidation and different capital requirements. For instance, in Europe, when we make a commitment to invest in our own technology, there's a capital consumption impact of that. That is not the case if you're just licensing it. So I think these are rules that evolved in a different world, and we think that they benefit all parts of the ecosystem, because our experience has also been fintechs are innovating and are often solving specific problems, bringing, in some cases, market-specific enhancements, in some cases, technology-specific enhancements. And most of them are not all that far removed from a bank, whether through a back leveraging situation, whether because they're looking for sort of a banking as a service for certain tools behind that. It depends. And I think banks will continue to work in partnership with fintechs where it makes sense in certain geographic concentration areas. But there are also, I mean, fintechs, not every fintech is a customer-facing fintech. There are plenty of ones that offer other kinds of technology that are solving problems behind the scenes. And you know, we welcome a competitive environment and want to be a part of it and look at a platform model of business that's going to serve customers. It's also going to help fintech sort of in a B2B2C way. And we see it as a transformational opportunity for the sector.
Okay, that's quite interesting. So what I also hear perhaps in what you're saying about regulation is this idea of having a level playing field. Am I right? Could you elaborate on what, from a brick and mortar bank, what is a level playing field when we talk about regulation?
I think it's that the concept of regulating banks has come out of a construct that is increasingly less applicable to certain parts of the economy. I mean, if you look at, if you want to go back 2 generations when the mainstay, I think similar to what you were saying about how you pick up customers, or that a mortgage being the link to the life of, you know, the customer and getting the finances is another point where things might change based on who gives the best mortgage rate. Now you look at consumers will make 3 to 6 payments a day easily as a touch point with the customer and data. That, you know, might have 3 mortgages in a lifetime. So we've seen a tremendous change in how consumer behavior and interaction with the financial sector has progressed. And from a regulatory side, as is often the case, it's still looking at it in ways that may not apply. I mean, certainly I agree with the point that when you're talking about systemic financial risk, I think the other piece of that sort of equation has been very, very intense regulation with visitorial powers, which means that in many cases your regulator can just walk in and take and look at and do anything. I think in Europe they call it kind of regulator supervisor. But for a bank, that makes a lot of sense for certain areas, but not for others. And from a brick and mortar perspective or an online bank perspective, if you're doing things to help consumers with payments, if you're doing things that are activities that other businesses can get into, we'd like to see more proportional requirements and the ability to set things up in a way that doesn't necessarily bring the same barriers to innovation that we face. And many of these barriers are not obvious upfront things. They're behind the scenes, like how capital consumption is looked at, what's consolidated in a perimeter. And they're things that banks worry about. And by the same time, we also know that that's why we think when we look at the largest tech companies, they don't really have an incentive to become banks. It doesn't make sense from a balance sheet or equity perspective. And it makes more sense to partner with a bank. And I think that's where there's sort of this bridge. In many cases, there might be a fintech company with a specific innovation. It's going to partner with a larger bank, and the idea might reach a larger market share through a larger tech company, and you have all 3 working together rather than this being a zero-sum game.
Can I give an example of the level playing field from a fintech perspective? One of the things that we're encountering is that often regulation is cast in the light of what the experience of a brick and mortar bank is. And I think that one of the things needed to do to level the playing field is to recognize the fact that digital players are entering the game and do things in a very different way to an incumbent bank, and the regulation needs to be recast to take account of that. One example of this is that in the UK, Starling, along with all the other banks, has to publish statistics on how long it would take for a person to come and open a bank account. Now, this regulation specifically says that the time period should be from the point at which the consumer has submitted their final document that is necessary to the point in time at which they have an open bank account. Now, for Starling Bank, opening a bank account can take as little as 5 minutes for the vast majority of our customers. So you sit down, you download the app, you go through all of the KYC and checking process online, you submit pictures of your identification, you submit a video of you saying a phrase we have given you in order to ensure that you're not impersonating someone else, and so on and so on. You go through all of this, credit checks and so on online, and you can get an account open in 5 minutes. So therefore our figures look quite good. And there are incumbent banks whose figures also look quite good. You know, they're comparable with us. The reason they're comparable with us, in some cases, I won't mention names, is that what their process involves is you go online, you apply for an account, you then apply to go and have an interview in a bank branch in a week's time. You go into that bank branch with your documentation, and at that point they check your documentation. And because they're checking your documentation in the bank branch, that is where the clock starts. And so they can say, oh yeah, we open accounts in, minutes as well. And that's because they're starting the clock in a different place. These two things, from the, common sense perspective of someone in the street, are not comparable. One is a week and the other is a day, but because the legislation has been written from the point of view of the incumbent bricks and mortar banks, it makes them look as good as, in terms of account opening times, as someone like Starling Bank is, whereas I don't think they are. So I think that's another playing field leveller that needs to be taken into account.
We may be coming back to the issue of the level playing field, but since we are now talking about regulation, perhaps we could have Janos's 2 slides, please. So if we move on to discussing the regulatory side, Janos, in your experience, what has been some of the regulatory challenges to deal with the emergence of fintechs and the rapid technological changes in financial services? In particular, do you see a tension between, on one hand, fostering competition in the market for financial services and ensuring financial stability? Are these, in fact, perhaps mutually exclusive objectives? Janos, please.
Thank you very much, Ania, for this. What I thought about doing is visualizing a little bit why the topic of big tech matters, especially in the topic of competition, but also regulation. This is, when does it matter to actually regulate? Regulators have limited time to supervise different entities. The reality is there's 3 stages. Too small to care, which is startup with 1 or 5 people, and a regulator is not going to enforce against you. You may be breaking a rule, but really, if you do it from a time cost perspective, it doesn't really make a lot of sense. After, you have too large to ignore. You now start to have a market cap, a balance sheet size, or a customer base, which starts to mean that from a consumer harm perspective, it's important that we start looking at you. And then you have too big to fail, systemically important financial institutions. The reality is that 99% of fintech companies are too small to care, either because they didn't get the traction and the penetration in the market that they had to, or because they're B2B players directly servicing financial institutions. There's very few companies in the fintech space which are too large to ignore. For example, Revolut just raised $500 million at a $5.5 billion valuation. It seems big, but HSBC is $150 billion. Revolut is only 2.5% of what HSBC is. So, too large to ignore, certainly. Too big to fail. If Revolut was to close tomorrow, would we care in this room? Not necessarily. On the other side, Libra, Facebook, but all the other big tech companies have made a realization for regulators that they can overnight become too big to fail. Facebook is $400+ billion of market cap, and they had an impact of providing a currency to 2 billion people on the back of a press release. This is the reason why today the discussion of big tech is on the agenda of regulators. A single press release of a big tech company has made regulators realize they can enter very quickly financial services. Now the question is, how do you approach that? The second slide is perhaps to narrow down the discussion that I think we're going to be having today. Big tech is both a Western phenomenon. We talked about essentially the GAFAs, Google, Amazon, Facebook, Apple. All of them have market capitalization which are higher than financial institutions. Their return on equity is 30%. The return on equity of a bank is 7% on average. On the other side, you have big tech in Asia. Now, both of them, whether in the West or the East, have entered financial services, but they've done so differently. When you look at entering financial services in the West, and essentially as the person from Santander was saying, big tech firms are very much partnering with financial institutions. Wells Fargo with Amazon to provide loans. Goldman Sachs with Apple to provide credit card. And now Deutsche Bank opening a tender for GAFAs to provide the core banking. However, in Asia, big tech are directly entering financial services and providing themselves the product. Now, there's a convergence now happening, and this is where the competition element starts to be interesting. The convergence is big tech firms have realized for different paths that it doesn't make sense for them to be in financial services yet, and therefore they'd rather be infrastructures. So when you think from a risk perspective, the risk is not so much now on the product side, is on the infrastructure side. What if the payment rail of Facebook servicing 2 billion people was to collapse? What if AWS server that is hosting all the banks was to collapse? Those are some of the elements which are important when you think about competition. And this is really it about those slides, but if you now therefore bring this evolution and this timeliness of it, you now have the question about competition in financial services. As Jason was saying, 2007 was very much a realization for regulators, we need more competition. Why? Because financial institutions could not perform their function anymore. Lending was not happening. We needed to re-inject competition in a market that was more and more oligopolistic. In the UK, 4 banks were doing 80% of the lending. So let's create competition. Competition is about the unbundling, adding more actors. But if you look at the trend about big tech in the US, big tech in the US has reduced innovation and increased concentration. Therefore, the question becomes, if big tech firms are to enter financial services, why should they or why would they change what we have witnessed in the US, which is a reduction in competition? Entrepreneurship in the US is at an all-time low comparatively to what it used to be 10 years ago. Why? Big tech firms are acquiring other firms preemptively. Facebook owns WhatsApp. Facebook owns Instagram. There is not a single element of your social media activity ex-China that is not covered by a single player. Why should they change their behavior when they enter financial services? Now, as a last point, and therefore on the topic of harmonization, the reality is innovation in financial services was a bad term before. And so innovation in financial services was considered negatively. But now, going forward, competition in big tech is essentially making it even worse. So what we need to start thinking is, do we want a level playing field? This is going to be complicated for a series of reasons. The first one is, if we think about where the regulatory gap is, you have financial regulation, consumer protection, data privacy. If we want to think about cross-border harmonization of regulation, data privacy today is a new term for tech nationalism. So you won't necessarily have harmonization between financial industry because countries, just from a data privacy perspective, are protecting their home turf, whether it's the US, Europe, India, or China. So that's going to be one. The second one is there has been a big issue on regulatory arbitrage. There's a unilateral movement of data from financial institutions to tech companies, but tech companies don't have to reciprocate this. However, is it a bad thing if Google wants to provide our financial services? We don't know yet. And I think the issue is more, how do we cater for Google or Baidu to collapse, as opposed to give them exactly the same rules as a financial institution.
Okay, thank you for that. I'm sure this leads to some thoughts in the audience about the impact. But before moving on to discussing the possible trends of big techs inside financial markets, I'd like to turn to Sarah, because as we started by saying, we have also seen quite a lot of consumer benefits arising from innovation in financial services, ease of access, mobile payments, one-click shopping, and so on. Nonetheless, there may be some risks related to that, especially the data sharing aspects. And I know, Sarah, that in Australia, this is something that there's been a lot of awareness, and the ACCC has taken quite a few initiatives. So perhaps you could talk to us about what may be the pitfalls of these open banking systems for consumers, and especially what is the ACC doing to try and counter those and protect consumers?
Yeah, good afternoon, everyone. Thanks, Ania. I think first I should give a disclaimer to let you all know that the ACCC is not a financial regulator, and so in terms of level playing fields and who's going to be regulating big tech, it's certainly not going to be the ACCC. However, we have had in Australia an increasing role in the financial services sector in a different way, and as Ania has indicated in her question, we are moving very rapidly towards the introduction of a consumer data right, which is going to be very similar to the open banking concept in the UK. The difference in Australia, though, is that the consumer data right is an economy-wide innovation and policy. It's not restricted to banking. So it's starting with banking, but the government has already announced that it is moving on to electricity and telecommunications. And so one of the challenges that we have at the moment is designing and building a system that will reflect open banking and enable immediate real-time data sharing between banks and Fintechs, but also do that build and design of the regulatory framework, the legislation and the consumer protection rules to apply not just in financial services but across the economy as that data right is rolled out. I just want to turn, though, before coming to some of the risks, just to have a look at the, what are the benefits of Fintechs? And one of the things I always find slightly challenging, not having a financial sector background, is just really working out, well, what is a Fintech? Because Fintechs can, as I have come to learn, really range from really quite sophisticated players who are banks, who are covered by all the regulatory protections and regimes of the banks that have, hundreds of staff and a great infrastructure, through to, little, one or two person startups that are run out of a garage. And in terms of the consumer data right in Australia, when we're thinking about these things, one of the things we have to think about from a consumer protection perspective is just those different levels of sophistication, and in particular what those different layers or levels of sophistication can do with consumer data. In terms of the situation in relation to competition in financial services in Australia, it sounds to me that our situation in Australia is very similar to that has been described in the UK. I have also heard that quip that you're more likely to get divorced than you are likely to change banks, and I think that in Australia the statistics are extraordinary. I think it's something like sort of 60-65% of people have never changed a bank account, so they still bank with the same retail bank that they started with either at school or when they shortly left home. In relation to policy developments in Australia in terms of enhancing competition, we didn't have the same extraordinary impact from the global financial crisis, but we have had a different, a different driver to really introducing these significant policy changes. We, over the last few years, have had a very extensive Royal Commission into the financial services sector that's covered traditional banking but extended through to superannuation and insurance companies. And that has been a Royal Commission of great public interest that has involved very senior banking executives and insurance executives, chairmen of boards, CEOs having to front up and be cross-examined in public about some of the exceedingly poor consumer protection practices that have taken place in Australia. And I have to say that, you know, some of us, including myself, are a bit cynical about what this Royal Commission would demonstrate, but some of the poor, extremely poor things were, I have to say, sort of shocking. And so what's happened as a result of the Royal Commission in particular is that the government has said, well, these banks have been complacent. We know that the margins in retail banking in Australia have been consistently high for decades and higher than in other OECD jurisdictions. And in response to all of that, the government's introduced this new consumer data right. And the benefit of the Fintechs coming in is then obviously, you know, twofold. Firstly, to shake up the competitive landscape, to disrupt that landscape by the sorts of offerings that we've heard about today, and also to offer consumers a lot more innovative and new services that they can use in relation to their data. However, clearly there are some potential privacy and other challenges associated with data zipping around the economy in real time. This consumer data is obviously extremely sensitive, contains all sorts of very personal information, and so as this legislation and this new policy was being developed, there was a very loud advocacy attempts from the supporters of privacy concerns, because we don't have a GDPR in Australia, and I think there's a general consensus that our privacy regime needs some modernisation. So some real concerns about, well, how are we going to manage the security and the privacy that goes with the consumer data right, and how are we going to manage who's getting access to that data? So if you're talking about, you know, a one or two person fintech operating from from someone's back garden, how can a consumer be sure that their data, if it's shared with that fintech, is going to be safe and secure? So the way that we've dealt with that is that the ACCC has been tasked with an accreditation function, and what this means is that any fintech or other player who wants to come and receive data in the consumer data rights system in Australia will need to come along to the ACCC and be accredited to do so. So in a sense, the ACCC is going to own that risk. And the kinds of things that we will look at is do a fit and proper person test, make sure that the fintech has appropriate insurance, and make sure that the fintech has a very strong IT security system that has been independently audited and an assurance provided to us. There are also very strong privacy provisions contained within the consumer data right legislation, and there are very significant penalties if that consumer data right is misused or breached in any way. And finally, we've designed the consumer data right so that it is completely driven from a consumer focus, not from industry, not from big tech, not from anyone else, but putting the consumers front and centre of the policy. What that has meant is that we've spent an enormous amount of time working out what consumer consent looks like, and making sure that there is very clear disclosure and very clear explanation to consumers about which of their data is to be shared, for what purposes, over what time duration, and also consumers have a right to completely delete or de-identify that data. So the data can't be collected and then sold offshore or collected and used for some other purpose besides that which the consumer has asked for. There's been some feedback from the fintech industries that say, look, these requirements are too onerous, and it was interesting to hear Margarita's points this morning about there is this fine line between having so much consumer protection built into the system that it's a disincentive to fintechs to participate, and that some fintechs won't be able to participate. So there is that fine line. We've taken the view that we focus on the consumer first, we get the protections in place first, and that we are able to loosen those over time if that becomes warranted.
Okay, I think that's a very interesting point about taking the consumer's point of view in designing the consumer data rights in Australia. And I've been wondering also while listening this morning whether there isn't perhaps an inherent tension between the aim of the Open Banking Initiative or the PSD2 and the GDPR for consumer consent. I mean, as a bank, Jason, how do you handle, and do you see a tension between the two, and how do you ensure consumer trust while adhering to the open banking principles?
Yeah, absolutely. I see no tension between these two things whatsoever. I think that they are actually complementary. The idea behind both of them, I think the overarching idea behind both of them is simple, and that is that as a consumer, you own your data. So in the same way that when you go into a bank and put your money in the bank, it's your money, and the bank can profit off it in aggregate with everyone else's money, but if you come to the bank and say, I would like my money back, please, the bank has to give it to you. In the same respect, that is true of data. So you give your financial data to the bank, and the bank can profit from that data in aggregate with everyone else's data. But if you come along and say, I would like to take my data, please, and go and use it somewhere else, then the bank should give it to you. And this applies both in the open banking sense of, I would like to take my data and transfer it to another financial services provider, a mortgage provider, a pension provider, or whoever, in order to get financial services from them, but also in the GDPR sense of, I would like to know what my data is, and I would like to remove my data from your purview and eliminate it entirely. So I don't see these two things as conflicting at all. I see them as what they're trying to do together is put a duty on the banks to take care of customers' data, to make it clear to customers what is happening with their data, and to allow the customers to move that data around in a safe and secure manner.
Okay, so if I may ask the same question to Joel, are the requirements on data protection and consumer trust different when you are a traditional or brick-and-mortar bank?
I don't think so. I think there are some maybe level playing field issues, as we were discussing before, with how PSD2 works. But I think generally, Janos' point is very well taken, that there are always going to be differences at the national level. And when you have, having been in a 100% digital bank in the United States, it's a little bit of a different setup when you have one legal situs of deposits and activity. Now, obviously, there are certain things when you go into other jurisdictions, but if you look at a global institution like Santander that has a retail presence that competes as a national bank in each of these countries, there's a panoply of local regulation and local views on this. So I don't think that there's a tension. I agree with Jason that our preference, we always have consumer consent, and what the consumer wants at the as a touchstone principle, and how we want to build products and provide better services. But when you talk about harmonization, like Janos was saying, that's where there's going to be more of a tension always potentially when you have different national sovereigns and different rules, and making all of that work together. Because I think the EU is a special example, because you have GDPR and you have a system that, at least within Europe, has defined how all of this works, but we're still defining it. I think, as Sarah said, Australia is also a very sophisticated and mature financial market. It's going to chart a slightly different course, and how are all of these things going to line up?
I wanted to come back to you, because I think perhaps it was deliberately provocative, but perhaps also with a bit of truth in it, as it often is when you talk about data privacy as being tech nationalism. Do you want to elaborate on that, and how these data protection rules, are you seeing them as being in an opposition to competition, to global competition, for instance, in financial services?
So the short answer is, I still think that if we agree that we live in a data economy, which I think most people of us, we do agree on this. If we're in a data economy, therefore, from a monetization perspective, we want to make sure that our resident or national get to benefit from this. We don't want to have that benefit transferred over to another country. And I think this is one of the thematic that is currently happening more and more in countries. Now, if you think about tech firms, they only care about large markets. They're not going to go in a 2 million plus country. So you have the US, you have Europe as a harmonized economy, you have India, and then you have China. China is a Galapagos island. Nothing goes in and out. including data. India was interesting. India was open to competition in financial markets, but also in e-commerce. And suddenly they started realizing, I do not want my data, financial or not, of my citizen to go out of my country for those countries to build better algorithm, machine learning capacities, and ultimately consumer-centric products. So what India has done, nationalism, data residency rule, where you can only process the data locally, which creates a barrier to entry to the e-commerce, which are Americans, or the payment firms that entered India as well. The second one is then you have Europe. Europe is lacking big tech firms. Now, how is Europe protecting itself against American big tech? GDPR. It's a cost of regulation, a cost of doing business that now enters that new market. If I now take the GDPR PSD2 example, I actually think in financial services it's an amazing thing. It's kind of the new big bang of financial services where, broadly and simply speaking, GDPR is about cleaning the mess. Yes, we need to know about the data, but first of all, it's assuming that financial institutions knew the data they held on you. And the reality is they didn't. GDPR was helping banks to force clean their data so that if there is a data breach, they can notify you on where the breach has been happening and what data has been lost about you. PSD2 is, now that we've cleaned the mess, you share the best. So financial institutions now have an obligation to share data with trusted third party. Now, if this goes between the banks, you increase competition because you're in the same sector, the same standards of regulation, and the same actors. However, PSD2 is open to financial services, but also non-financial services that can pull financial data. And I think that's the question where the competition might be distorted. So GDPR and PSD2 as a combination, fantastic in financial services. GDPR and PSD2, when you look outside of financial services, this is where we don't really know yet what is going to be distorting competition.
I think on Janos' point, from our experience, that distortion is already happening. And while certainly you can argue some of this may dovetail with a sort of nationalistic, or in the case if you're a continentalist perspective, you see that exactly happening where data generated from European customer, European transaction is ending up in the hands of other tech companies. And it's not necessarily per se a bad thing as long as all the rules and consumer consent is a touchstone. But we'd like to see the balance on the seesaw where the other data, again, with the same consent as a touchstone, can come the other way so that there is sort of the promise of PSD2 can be realized even more fully.
But on that side, and I think this is where the exercise we haven't really seen the full way. If we also do agree that big tech firms don't really want to enter financial services, why? Because margins are low, it's expensive. And like I said, if you look at the cap of a financial firm and a big tech firm, why should they start providing directly financial services? So I think that PSD2 had that potential, and I think they were testing the waters and trying to see. I mean, since PSD2 arrived, all big tech firms have now a PSD2 license in Europe. So they started doing that. But I think they're all realizing that it's much more profitable for them to just be infrastructures at the back. That's core to their business. You have no regulatory capital against this. And right now, most regulators are not really realizing what it means about having AWS providing 90% of the cloud services to financial institutions. So there might be a competition distortion, but I actually think that big tech don't necessarily want to now enter financial services.
I agree with you 100%. Everything I think you said makes perfect sense. The part that I'm saying is with this piece of data that are generated non-financial data out of that side of the transaction, we'd just like access to it as well, because I think that those big companies, like you said, their infrastructure, and the other piece is data, total data economy. That data has a lot of value to them. And if there's a touchstone of consent, they're getting everything from our end. If we can have the same consent, we'd like the other end of that information. That's the only point where I feel that there's some distortion. And to your point, I agree with you. This is very new. We're still seeing how it unfolds. But from our end, we're already feeling that, particularly as we're looking toward a platform approach, and we want to work with Fintechs and other partners and grow this. And it's a pain point where we can't get the same information. Okay, so it seems like that we've kind of spontaneously moved into a discussion about the big techs. So before we do, we move that, perhaps we could ask the audience now for another question.
which is, would you bank with a big tech such as Amazon or Facebook or Google or any other of the big brand names if they started providing proper banking services? So yes or no, would you bank with a big tech such as Amazon or Facebook if they provided the service? And while you answer this question and you think about what might be the implications, I will turn to Sarah, because it seems to me, some would, okay, interesting. It seems to me that what we're looking at is, from a regulatory perspective, this is clearly something that goes beyond simple prudential regulation or simple consumer protection regulation. We have issues of privacy, issues of data rights, and so on. The OECD has highlighted in previous roundtables the need for different regulators to cooperate, but how easy, how feasible is it in real life and in fact for the different regulators to have a joined-up approach, and especially what do you see as potential systemic risks emerging from big techs entering financial services, and is it something that regulators should be concerned with?
Well, there's a lot in that question, Ania. So let me tackle it this way. I thought, perhaps before I come to your question though, just to follow up on the discussion that was just taking place. In terms of the consumer data right, one of the big questions that is just starting to occupy us at the ACCC is to think about whether or not the big tech platforms, and I'm thinking in Australia the main players are Google and Facebook. We don't have much of a presence of Amazon in Australia. But whether these big tech companies are going to apply to the ACCC to be accredited recipients of data under the CDR. Now, of course, they don't need to be banks to do that, to apply for that accreditation, and I agree with the comment Janos made earlier. I don't see any reason why they would. I can't see the logic for, not being an expert in the area, but I can't really see the logic of why they would want to enter financial services. However, you know, the consumer data right is not about accredited data recipients becoming banks. It's all about use of data, analytics of data, monetising data, and providing services to consumers using that data. It really, given the market dominance and the current multiple data points that each and Google and Facebook have with their consumers, you know, it does, as a regulator, as a consumer protection regulator, cause me, you know, pause to think that if data is shared from consumers in relation to all of their banking transactions, their direct debits, what they spend money on, when they spend their money, and that is all shared with Google and Facebook, and they can combine those data sets, it seems to me that will create effectively an unassailable market position. And in fact, Amelia Fletcher and I were talking about this very point over coffee this morning, and she made the point that that kind of data, and I hadn't thought about this before, but that kind of data combination would allow Google, for example, to see the immediate effect of its advertising and where it's directed to. So if Google could actually say, well, we sent this targeted advertisement to this consumer in response to this search, and look, here's her banking records that show that 3 minutes later she made a purchase. The value in that kind of information, you know, I find it slightly terrifying, but also, you know, would be of incredible value to advertisers. So we're going to really need to have a close think about how that is dealt with. And just coming back to the level playing field, although we don't use that word in the discussion in Australia, but the word that was thrown around a lot when this consumer data legislation was being debated was the word reciprocity. And I think it means the same thing from what I'm hearing. And the reciprocity issue was, while the consumer data right is really all about opening up banking competition to Fintechs, a lot of the conversation was was being had within the banks was not really concerned at all about data flowing to fintechs. What they were really concerned about was data flowing to big tech, and what big tech would do with that data, and would they then enter those markets. So we have got the concept of reciprocity in the consumer data right legislation, but I'm not sure that it would solve Joel's level playing field concern. And the reason for that is that this stuff is all consumer-driven and consent-driven. And so it's not the case that if I direct my bank to share data with Google, for example, should that ever come to eventuate, it's not the case that there is sort of an immediate obligation on Google to share all of my Google search history and other transactions back to my bank. Because, you know, why would I as a consumer want that to happen? I don't know. Maybe there are good arguments for it, but the only way that could happen is if a consumer made an active decision in order to do that sharing. And at the moment, under our legislation, that could not happen in any event, because the only data mandated to be shared is effectively banking data. That's what's provided in the legislation. So if Google, Apple, etc. are not operating as banks, then there won't be that two-way flow. Now, I haven't answered your question at all, Ania, but I thought those points were particularly relevant, and now I can't remember what your question was.
I'm not sure even I can at this point. No, it was about, but I think it's very connected to the point you're making. So my question was about systemic risk. And even going beyond banking services, I mean, I know, so we discussed it yesterday, that there are some concerns amongst regulators, even not looking specifically at financial services, but of some systemic risks emerging from the role of the big techs in the economy. Did you want to comment on that?
Well, all I would say about, I mean, as I said before, in terms of systemic risk of the financial system in Australia, that's not an ACCC issue. You know, that's the prudential regulators, and we have market and integrity regulators as well. The thing I would say is that, and Rod, our chairman, touched on this morning, what we are learning though is that sort of no one agency can tackle these issues, and dare I say, no one country can tackle these issues. And so when we did our digital platforms inquiry that Rod touched on this morning in his comments, one of the things that we recommended was that the regulatory responsibility for oversight of the digital platforms be shared between a number of regulators. So you've got the work of the financial services regulators, obviously, over in the financial sector, but we recommended that in terms of regulating digital platforms, it would be a combination of the ACCC as the Competition and Consumer Agency, then our ACMA, which is the Communications and Media Authority, and then separately there's a very significant role for our Privacy Commissioner and the Office of the Information Commissioner. So that sort of follows up, I think, on some of the discussions on the panel this morning about this real intersection between competition issues, consumer issues and privacy issues. And certainly over my long time at the ACCC now, you know, you would not have heard discussion of privacy issues at the Commission even only 5 or 6 years ago. Now around the Commission table, privacy both as a consumer issue in the sense of misuse of data, misrepresentations to consumers about what's happening with their data, but also privacy settings as a potential source of competition are being discussed, and also in relation to mergers and data and how data acquisition is used in mergers. This has just become a really regular part of our dialogue.
I completely agree with you, and I think without revealing too much, working on the digital economy has been part of the OECD work stream. I think we started in 2016 when we had a discussion in the Competition Committee about big data, and it was clear that one of the issues that emerged at the time was that privacy considerations were coming to the fore, for instance, in merger discussions. And at the time, as you said, it was said, well, this is not a competition issue. And I think that things have evolved very much in that sphere. I noticed, Jason, that you were, bounding to, and I think it was on the data issue that
Yes.
you might come in, and then Janos after you.
Yes, absolutely. This is on. I wish to sound a note of discontent about the consensus building about data reciprocity. So as the representatives of what is closest to a tech company here, I would like to say that when people start talking about data reciprocity and, oh, you know, we're giving you some data, so you'll give us some data, right? I'm like, well, this is like going to a steel firm and saying, can we have steel reciprocity, please? So I have the tension here is in the UK, at least, and I think this is going to become more widespread elsewhere, we are seeing more and more of this multi-banked persona, this person who has multiple bank accounts. And the way that these multiple bank accounts work is that, generally speaking, a person will have, these multi-bank people will have two bank accounts. They will have a bricks and mortar bank account where they put their money, and they will deposit their salary into it and pay out a few important bills. And then they will transfer a load of money over to their digital bank account, their FinTech bank account, and they will do their day-to-day spending out of that. And what that means is that they have effectively divided their trust in money, trust in deposits to the incumbent bricks and mortar banks, and their trust in their data to the Fintechs, because we have shown that we are more able to handle their data and give them access to their data than the incumbents. So the problem I have with data reciprocity when people come along and talk about it is that, you know, we're going, well, at the moment, that's the main thing that we have an advantage over, and now you're asking us to share it. So I will, you know, ask to Santander, if you want data reciprocity, would you be willing to exchange deposit reciprocity? Can we have some of your money? And then the question is, well, no, consumers get to choose where to put their money. Well, don't consumers get to choose where to put their data? I mean, that's, you know, this is the question that I'm sure the tech firms will ask in greater number as well. You know, the reason that we have been, the reason that the consumers keep spending on Amazon or keep searching with Google is because they trust us with their data. And, you know, and if they stop trusting us with their data, then they'll stop, giving us their data. So I'm slightly playing devil's advocate here, but, you know, that is the sort of argument that will be faced back to requests for data reciprocity.
Joel, for a quick comment on this?
For us, I think the data that we're talking about is slightly different, because I think normally the relationship between the FinTech partners and the bank and open banking, that's more or less already resolved under, certainly in your PSD2 regime. We're talking specifically more about non-financial data that through the sort of complicated interface of terms of use and consent that's been given leads to another player getting and being able to aggregate that data that gets used for product development and other things in a much bigger picture aggregate use, where we have products and ideas that we'd like to be able to develop and make better offerings that rely on it. So it's, in my sense, it's not about the specific data that I think you're referencing from, at least my perspective, from a digital, global bank. Sure,
and my worry is that while that is not your intention, will that be the eventual outcome if, some sort of data reciprocity, regulation, legislation came into play? Would that, and again, this comes back to the level playing field thing of, because legislation is more geared towards how the incumbent banks work, would that actually be the outcome? That is my concern.
Sarah, I thought you might, given that you were talking about how the consumer consent at the moment is not, in fact, two ways, right? You consent to your data being shared with the FinTech, but there's no reciprocity going further with the data. So did you just want to comment on that? Or?
Oh, well, there's probably not much more to say on that, Ania, in the sense that because we've put the consumer at the heart of things, then there is just no automatic right of reciprocity. In fact, I think it's a bit of a misnomer in some ways. A consumer can consent for his or her data to go from a bank to a FinTech, and as I say, conceivably in the future from a bank to Google, Apple, big tech, if they're accredited and go through that, all of those things that I talked about earlier. The question then is, do you bring in big tech into the consumer data right in some way? Do you put obligations on them? And I think certainly the Australian government down the track has that in mind, but that's just not going to be imminent. I guess I was picking up the microphone because I had a question for Joel, which might be slightly rude of me, but I'm just genuinely interested. When you talk about that the bank would like to access, I think you called it non-financial consumer data. I don't know if you can answer this, but I'm just interested in, can you just give an example for me about what, because I haven't heard this before, sort of what sort of data, and then what might that be used for? If you can,
Sure.
It would be very helpful.
I can give you two examples. One more mundane and one a little more progressive. One, I think the more mundane one is just there's certain opportunity. If the bank knows that you're in the interest for, you're in the market for a new car or a new house, there are certain products that are just like any other company would do and have the ability to tailor products and things to help the consumer with consumer touch and as a consent. Again, that's more mundane.
Would that be like accessing, sorry, Ania, to start asking questions, but would that be accessing, for example, Google search data? So someone puts in, buy a new car, and so you're thinking, oh, well, that would tell you this customer of ours is in the market for a new car.
Well, there has to be a transaction under this framework. So we're talking about non-financial transaction data. So we're not talking about going, I think the idea is that sort of balance on the seesaw of PSD2. But let me give you, I think, what I think is a more interesting example, though it's not exactly in the marketplace yet, that I think is something that protects consumers. And there's been some research about consumer trust of information, that there's so many things where we authenticate ourselves and our identity go into systems, and there's a transmission of this data that creates risk. I mean, particularly, in the United States, you can see a lot of press about breaches and stories. Like, I'll take an example of a hotel chain that collects all this information to check you in that the hotel chain may not really want to be responsible for. And there's a large hotel chain a few years ago that had a major breach. Imagine if you had sort of an identity as a service kind of aspect of this, where your bank is trusted and has this, and all the data points that come from these non-financial things can help authenticate you, and they can get an answer from a system. And obviously, you go burn down the hotel. Yes, we can tell the hotel who it is, but the hotel's happy because the hotel doesn't have the responsibility for this information. It's not really key to the business. The consumer's happy that there's not been another transmission of that consumer's business, and the bank has been able to offer a value add. So again, we're not there yet, but I think that's another example where that non-financial data, at a transactional level, we're not talking about what I think happens in other sectors where you do have in your terms of service from, again, not Jason's kind of technology company, but others where you have no idea the amount of information that is pulled and accessed from your smartphone, location, and other things that is being, for lack of a better word, manufactured, and what kind of information has been worked up in sort of a profile somewhere in a server. And so this is not about that level. This is about transactional thing that will allow a bank to offer better services. And I think, to Jason's point, where there might be more balance on the seesaw the other way, this could be a service that could help many other companies that are offering FinTech products, again, where there's more alignment than divergence.
So in a way, what you're concerned about is that data that could be used perhaps to influence the behavior of the consumer, but where the bank would actually not have any control over or even being able to receive this data, but it would be drawn from the transaction and allow a big tech to somehow intervene in the market.
Well, that's what's happening now. I mean, we're not there. They are getting all of the financial data through PSD2 through a chain of actors. But the other non-financial, that's not shared the other way. I mean, I think in Jason's analogy, in many cases, other than the parts that FinTech actually controls and has that, neither of us are getting it.
Okay, so in the interest of time, and because I would also like to have some questions for the floor, I'll turn now to Janos to round up this discussion. We've touched about a lot of different issues related to the influence of big tech data and regulation, and I know you wanted to come in on that, Janos. And then after that, so if you have some questions, you can think about them in the next 5 minutes while Janos rounds off this.
So I think what was just said was interesting about what is really a big tech doing using financial data to sell non-financial products. By shows of hands, who here checked in a hotel to arrive here today? So who is not based in Paris? Who here moved into a hotel in the last 6 months or 1 year? All of you realized what it is when you check in, you have to give your credit card as a deposit in case you trash your room. Here's an example of using financial data to sell non-financial product. In China, big tech firms are using your credit score as a way to sell you a hotel room. Now, you may think, what's the point? If you start thinking about this, a high credit score means you're not reckless, if I was to summarize it. Meaning, if you're not reckless, you're less likely to trash a room. Now, Alibaba or Baidu can sell you a hotel room, but now they give you a check-in experience where you don't have to put a deposit to enter the room. Meaning that you as a consumer can go straight from your phone to tap the door to open into your room, and now you have a better experience. Now, what did Alibaba do? They use a credit score, which is normally used to do a loan, but they use that credit score to sell you a non-financial product, meaning they don't have regulatory capital against it to sell you something. Their margin on selling a hotel room is 20% on a $100 room, which is $20 profit for them. If they were to do you a loan of $100, they would maybe make a profit of $2 and put a regulatory capital of 20 against it. So that's an example. However, now you have the question that we're essentially asked, which is, but what if financial institution would have non-financial data, or financial data, but non-financial data shared back to them? The question I have is, actually, could you even handle it? And I'm not talking from a tech perspective. I'm talking from a banking separation perspective. Banking, both in the US and in Europe after the financial crisis, but in the US since the 1920s, have a very strong separation. Financial institutions can only act within financial services. There's very tight limitation on a bank owning an e-commerce company. You had that proposal in 2000 when you had the Bank Modernization Act in the US, where JP Morgan said, I could be AWS. However, this is non-financial services. And so building non-financial product, if you're a financial institution, has very tight limitation on whether you're allowed to do it or not in the US and in Europe. And I think this is one of those limitations, which is if you had data reciprocity, then the bank can you actually build a brand new business on the back of it. And then it goes on regulation and frameworks. And I think Australia has a very good case point of the advantage of being a fast follower as opposed to the UK being a first mover. Open banking had its flaws. It started in the UK, and it's still 5 years later, not perfect. In many ways, startups have done a better job at doing open banking than the standard themselves. However, the question becomes is reciprocity. FinTech growth in the last 5 years and 10 years have been made possible because of a massive regulatory arbitrage. The challenger banks, they use the e-money license to become deposit holding and now full-fledged banks. Lending in China was because deposit rates were essentially capped and they could provide a higher return. So the FinTech growth on the B2C side has been a regulatory arbitrage game. And I think now, as we're rethinking in terms of regulation, we need to be careful that we're not rebuilding a new opportunity for an arbitrage opportunity. And coordinating regulatory body, but also creating reciprocity is going to be important. Because big tech is often about distorting competition. And one of the best things that essentially prevents oligopoly from happening is interoperability of data, sharing it. And I think having regulators talking about this is going to be a very valuable point.
That was very interesting, and I think it ties up very nicely the point that Sarah made about the coordination of the different regulators, which clearly is going to be necessary, not just for financial services, but clearly to regulate digital platforms. So I wanted to see, we have about 10 minutes left of the session, if there are any questions from the floor to the panel. We have two. I don't know if we've got some roving mics. So one here, please.
Hi. My name is Anastasia Dritzer, and
please stand up.
I'm a partner with KG Law Firm in Athens, Greece. I'd like to touch upon the issue of legislative change that's necessary to create a level playing field in the fintech/banking sector. And I'd like to share an example of what we faced a few weeks ago on representing a Belgian investor trying to invest in Greece. And in setting up the company, the Greek law provides that you need to deposit the initial share capital in a bank. So on inquiring with the bank how long it would take for them to open an account for us, they came back and told us, well, we'll roughly need a month, because needing to run the Know Your Client exercise lately is a very cumbersome sort of exercise. And similarly, we approached a FinTech provider, and of course they said that we're happy to open it in 3 days. But then when we looked at the law more closely, it was explicitly provided that the initial share capital has to be paid in a Greek, in a bank, in a banking institution operating in Greece. So with this example, I'd like to ask what your view is and what are the initiatives in actually creating this level playing field for this sector. Thank you.
Okay, we'll take a few questions before. Yes, here in the front, please.
My name is Valentin Mircea. I'm a lawyer working in competition matters. I would like to challenge Jason Maude again, because at his initial question, there is a challenge between GDPR and the Payment Services Directive. And taking into account, you said that money and data could be handled pretty much the same way. But money is a fungible good, as we call it. I go to the bank, I deposit a certain number of banknotes, let's say. When I go back and take my money back, I don't receive the same banknotes because I don't care. I receive some money, an equivalent, and perhaps an interest. Whilst data is specific, I entrust my data to the bank. When I want to remove it, I want back my data, not someone else with a similar age, height, nationality. No, I want my data. So, which creates headaches more than money does. And so I would like to think again with the question, but against this background. So how to move, but moving data back and forth is more difficult than moving money. So are you sure we are there, we're in a safe place? Thank you.
Okay, any other questions? There's one here in the middle.
Hi, I'm Mark Martinish, and I teach law at Queen's University in Belfast. I would like to zoom out and go back to the consumer in banking and stickiness of banking. And to me, the UK experience so far indicates that the ease of switching does not necessarily translate into switching. So despite the fact that UK banks offer lots of incentives, also financial incentives, few people actually do switch, right? And tested on students, they're not very enthusiastic about it. So most people are not inclined to switch. So we're facing some noticeable consumer inertia. So although competition is just click away, people tend not to click and people tend not to switch. And it seems that the threat of switching itself does not stimulate the market. So I'm not sure whether we're seeing better offering. You talked about new features, but I don't think that the cost is falling. I'm not sure whether we're getting more interest on deposits. It seems that, where you're thinking about overdraft charges that are going up, especially in the UK, I think that's noticeable, virtually non-existent cashback. So competition on price, I'm not sure we're seeing that. And I wonder what could or should be done to stimulate, consumers in this process. Okay. Thank you.
Thank you. So perhaps if we just go down the line, starting with,
Sure. So I address the question. So money is easy to transfer, data is not. Money is fungible, data is specific. So coming from Starling Bank, for us, data and money are more similar. The transfer of money from one person, from one place to another, is for us a transfer of data. It is for us transfer of data across an API to another, to the UK bank rails, which will then take the money off somewhere else. So I take your point that it doesn't. In some ways, it doesn't matter whose £60 you get, but it does matter whose data you get. But for us, the two things are reasonable, are the same, well, not the same, but they are very similar, they're very linked. Now, I think at your incumbent bank, they are much more different because the incumbent bank is set up to transfer money. That is what it has been doing for hundreds of years. It is not set up to transfer data. So for them, those are two very different things, and they will have a situation where their data on a particular consumer is stored in many different places, on many different systems, some of which are non-maintainable. We haven't got into non-maintainable data in systems in this panel, but some of it is very difficult to get at. At Starling, all of our systems are connected from the get-go. So if we want to grab all of a consumer's data and transfer it to them under GDPR or get rid of it or what have you, we are able to do that with pretty much the same ease as we would make a payment from one place to the other. So for us, these things are approaching more and more, to be the same thing. Money and data can be viewed in the same light, which is why I described it as such. In terms of the how do we stimulate competition, just briefly, yes, I agree with you. We have made switching to Starling very, very easy. Click of a button and it's all done for you. But we're not seeing the uptake. So competition on prices is one thing, and I think that the UK regulators are starting to ask questions on how have you set your overdraft charges? Please explain this. I think Starling has a good answer to that. I'm not sure whether other banks do, but those questions are starting to be asked. And I think that hopefully those questions will stimulate more competition. But I think ultimately what will cause consumers to switch is when they start having trust and can see a difference. As I said beforehand, there was very little difference unless two banks started aggressively competing on price, which I don't think was the case. But now I think there are more competition vectors. You've got not only price, but you've also got what features you're offering. You've also got how your data can be transferred from one place to another. So I think as more vectors open up, the likelihood of consumers switching will grow more. But inherently, people are conservative with their money, and so it will take a long time.
And I also think perhaps an answer to that is also general consumer inertia. Very much the same thing happened in the electricity markets after they were liberalized for end users. So consumer inertia is something that's inbuilt perhaps in the human nature, and it takes something to push them to switch. So Janos, do you want, basically there were three questions, right? So the views on the level playing field, and there was the example for Greece where despite all this, you must deposit your share capital in a banking institution. We have the challenge between PSD2 and GDPR, and then, of course, consumer inertia.
So on the Greek account, I think it's a good example of the limit of licensed passporting. However, on the other side of this, it means it's a very good opportunity for a niche challenger in Greece to be building itself specifically to hold these type of accounts. So essentially, it's the rise of niche challenger banks. On the data trust element, I'm not quite sure if people care actually about data yet. And the reason why I say that is, think about passwords. Passwords are, for different websites, are your gateway, your protection towards your personal data. Everyone here in this room had their LinkedIn, Facebook, or whatever account with a password compromised. Did we change it straight away after? Not yet. I think the sophistication of retail consumer around data monetization is not quite there yet. Why? Because data is cheap. My personal data is worth 0.0000002 cents. Do I really want to protect this? Not so much. I think the sensitivity is not quite there. The last one on account switching is very interesting. What is the trigger point for account switching? Bad customer service. That's the trigger point. I was talking about this to Jason earlier. It was Christmas time. I was with one of the challenger banks. My account gets frozen for 14 days. I can't touch my money. The only way for me to talk to them was through the app, in-chat app. The only way for them to respond to me was using Twitter. Now, what I was saying to Jason is account switching is actually quite easy to see how quickly you will do it. We're talking about you're more likely to get divorced and to switch bank accounts. As a disclaimer, I'm not married yet, so maybe I don't apply to that quote, but if the time it takes you to open a new bank account is less than the time for the old bank to solve your problem, you will create a switch. And I was telling that challenger bank that in those 2 weeks, I could have opened 240 new bank accounts with challenger banks. And I've done so. I've opened another 5 accounts just on the back of 2 hours of frustration, which now I'm relinking them to open banking. But the point is, customer service is a very good trigger point for the ease of switching. And the ease of switching, if shorter than the time it takes for a bank to respond to you, will essentially be the main trigger point.
I think, I mean, those perspectives are generally correct. I think in terms of, you know, the different things with the example in Greece and other places, I mean, nationalistic legislation is nothing new. Even within the United States, when I was at the first digital bank in the U.S., you know, and there was, I think, similar to what Jason's getting at. In the digital banking world, there's a real need to generate deposits, and you can offer better deposit products like homeowners associations. Well, state X, and this is, you know, a subnational law in the U.S., has a law that, well, to offer deposits to homeowners associations that are, you know, especially chartered mutual benefit corporations in that state, has to be at a bank with a physical branch in state X. And similar to the EU passports, as I was talking about, you have federal preemption as a federally chartered bank in the U.S. And so I don't think those sorts of laws and approaches are going to disappear. I mean, it's just a general trend. It's been a trend throughout human history. I think it's more what economic players do to provide better value propositions and to serve customers and how to solve problems.
And Sarah, finally?
Yeah, just quickly, I can't comment on the legislation in Greece, so I'll pass on that question. On the data ownership, or the moving money versus moving data point, the only point I was going to make on that, and I was going to respond to this to Jason earlier, because Jason talked about owning data and then moving data. In Australia, under the Consumer Data Right, we don't talk about ownership of your data. We talk about the consumer's power to direct the sharing of that data. So you can share your data, but it is still going to be held by your originator bank, so it doesn't disappear altogether. And then just finally on the switching point, I think it's an excellent question, and one that I think all of us that deal in competition in financial services, you know, grapple with. But I think, as I understand the experience in the UK, while switching hasn't dramatically increased with the evolution of open banking, what has happened is multi-homing has increased, so that, you know, as Jason talked about, people now bank regularly with more, or frequently with, more than one institution. And if you talk to consumers, and all the research shows, well, why don't people move? A big part of it is this whole issue of trust. And I do think, and this is my personal view, that as consumers become more comfortable with multi-homing, that exposes them to other banks, and it makes them see that they have systems and services and things that are competitive. And I think as that increases, more people will be willing to trust those new entrants and to move away from the traditional banks. And just finally, I think there might also be somewhat of a generational thing in this as well. So I have a number of teenagers, and they are all completely comfortable banking online. They've never seen the inside of a bank branch, and I suspect that they never will. And I think, you know, as that generation, the online generation, starts opening a lot more bank accounts and the like, I think we may well see, you know, a bit of a shift.
Thank you very much. As they say, time flies when you're having fun. This went past very, very quickly. As you're thinking about leaving the room, we have a final question for your apps, which, given the discussion we've had here, are you too worried, or would you be too worried about the safety of your personal data to bank with a big tech or a fintech? And that will be illuminating, I think, in light of the discussions that we've had. So no worries about data. I said that too quickly. All right, so some concern. Okay, swinging a bit forwards and backwards. So it remains to me to thank our panelists for discussing issues that have ranged from data protection, regulation, technology innovations, and whether or not your data are safe. So thank you very much, Sarah, Joel, Janos, and Jason, and please give them a hand. And I urge everyone to be back in the room sharply at 2:30. when the Secretary General of the OECD will be giving a presentation of a new publication. Thank you very much for your attention.